Happy Monday, everybody. Let's see if we're in focus here. I think we are. I think we're good, nice and crispy. Let's see. Oh, that's probably a little better. See, every once in a while it pays dividends to check the material. What up? What up? What up? Uneventful Super Bowl. Really good Super Bowl ads, particularly the 50-cent beef one, Grubhub. Solid advertising work there. We're going to go through the usual Monday routine. Checking the markets, checking to see what we're at. Looks like Japan's having continual bond issues over there. Not surprising given what we've seen. I do worry a great deal if that's going to tap into our markets and impact us the same way. Welcome back to the show. We are sponsored by Fridays. Go to joinfridays.com, enter the code HIGHER. You will get a discount. We will get some love. It's good for everybody. It's good for you, good for me. And for those of you who don't know me, I do microdose tirzepatide and am on TRT, as well as taking some peptides and some stuff like NAD. So I'm not only, a sponsor, but I'm also a client. There you go. Okay, so with no further ado, let's right into the stuff you guys are here for, the market status. We are in a bit of a back off from where we were on Friday. On Friday, we had a true bull run, a true actual run up. We had the Dow hit 50K. That was kind of crazy when you think about the context of it. Today, we are in a narrow tech-led rally. And as a reminder, as I always do, down here you get the status of the market bar as we jump through sectors. You're going to see how each sector is performing relative to the overall market. This is the ETFs as proxies for the indices because we do want to include things like derivatives and all the real-time trading. On this show, we're going to go through the status of the markets, let you know everything you need to know about what's going on out there today, whilst saving you all the time from having to watch CNBC all day long. We're not going to give you data, but we're going to actually explain what it means. And then we're going to hit the social media narrative, the rhetoric. We're going to leverage some of our AI tools, which those loyal listeners of the show have seen before. Those AI tools are going to tell you what's going on in the market in the top 7 to 8, in some cases even 9 and 10, but typically top 7 to 8 trending items on places like X and Instagram, and it's going to tell you what they mean. We are going to spend some time looking at some chart work from the social social sphere, because I do believe heavily that the behavioral economics and the retail traders do impact the market in a meaningful way. Shout out to Robin Hood, who pioneered the democratization of the market. That being said, let's get into it, everybody. Today we are in a narrow tech-led rally. The market is still reeling from Friday's jump-led spin. You saw that change in real time right there just now if you were paying attention. This is down from a growth run broad rally. We saw a true rally on Friday with the Dow hitting that 50,000 mark. Jumping into the synthetic volatility index, I like to hit this chart second. We saw a slight pickup in calmness in the environments. That has a lot to do with the fact that we're not running off of a rally. And I think a lot of people who were hitting me up in the DMs were asking questions about this. So I wanted to take some time to explain this. This, unlike the market status market, you still uses the same green and red kind of spectrum of good and bad like we're used to in school, but kind of gives you a different look at the markets, in that anything above this way is what I would call normal, healthy, just tension in the markets. Anything down this way, you start to get very concerning, and a panic flop here is going to be a very bad market for everybody. And for the most part, we're almost always above normal, as a healthy market should be, unless there's something catastrophic or some type of material that we'd otherwise be starting the show with in a headline. Now, the question that I kept getting was, well, Chris, why, if we're seeing the Dow hit 50,000, is the synthetic volatility index, this index that we've proprietarily built, that's supposed to be our proxy for the VIX, why is this showing a degradation in the ability of the markets? Why is it showing that there's more fear, because we're going from normal closer to tense? And we didn't get to tense, so we were still in a very normal risk profile. I think we were in the high 70s in this period here. And the reason why is, if the market spikes like that, because I think the long story short is, people were leaving the risk on perspective of cryptocurrency to going risk off into the industrials. And as a reminder, we believe heavily in the banking sector, at least right now in this particular climate, the banking sector, energy, and industrials. And the Dow saw the run up that we saw. I think that does increase some fear and volatility in the market. So this model is built to take, even though that's a burst in a positive direction, it's supposed to say there's volatility, realized volatility and intraday stress and gap risk. You're seeing things grow in a way that it didn't. And cross-market volatility really looks at how the other indices are performing as well, vis-a-vis those ETF proxies. So long story short, anytime you see a giant spike up in something, it's concerning if you don't have a clear and identified reason for that happening. It wasn't to say that the markets were really scared. As a matter of fact, I think it was showing confidence in the long-term durability of the markets and less confidence in cryptocurrency on Friday. But it doesn't create more volatility when things spike outside of normal, hence the slight degradation in overall stability score of this particular market. Jumping into our next chart, as we normally do, we are still in a restrictive Fed policy. Nothing material has changed here, despite the headlines that you see. The Fed is flush with liquidity, netting out the repo line, the treasury account. You still get a net liquidity score of 6. So I'm not seeing a ton of cash flood into the markets, despite the rhetoric that you're seeing from the FOMC and panels. And let's go into the housing affordability. As you likely know, it has not changed. And if you watched the last show, you know that I promised I was going to check on these numbers here. And believe it or not, so backstory, this plugs into Fred, the St. Louis Fed API, and pulls in real API data, including the average home price and the average interest rate. Believe it or not, that is the latest data that the Fed has available currently. And I know you're thinking, what in the hell? Q2 2025? We're in Q1 2026? Yeah. Triple checked, triple verified, went to the site, pulled down a bunch of data. That is accurate. And this is why we always say on the show that housing is a lagging indicator. A lot of the data that we get from the government agencies, that's your traditional government-sponsored stuff, is lagging that far behind. So whenever we say we feel differently based on what we see in the market, that's meaningful and important, and it's something you kind of have to acknowledge, because the market rhetoric is based off of outdated data. Now, we have analytics that are available to us, like, mortgage demand from listings, from closed sales, from the Mortgage Bankers Association. But I've always been a bit skeptical of said data, because each one of those organizations do have a vested interest in the outcome of home prices staying higher. Not to say that's the intent, but certainly you've got housing pundits, i.e. Logan over at Housing Wire, tremendous amount of respect for him, but he's always going to have a slant towards benefiting the upside. Now, in his defense, historically speaking, and guys like him, mortgage rate pressure is the easiest lever to pull, which pulls affordability back in line, but there's also home prices and wages which need to change. Take a look down here. We're going to see some dividends being paid out on Wells Fargo. You also have some of that on Citi here as well coming up there. So For those of you who want to look at dividend stock, Bank of America as well, Goldman Sachs as well, look for that yellow D down there in the real-time trading window. That is real-time stock tickers. Take a look at that. It'll let you know who, and obviously down here below, all the financial guys are paying their dividends. And that's another reason why we've been a big fan of the financial sector. If we're expecting net interest margin, the profitability of these institutions to increase, you can expect good dividends in the quarters to come in the future. Part of the reason why we feel so strongly about that. And I'm showing a whole lot of dividends here. I'm going to check the server unless I'm crazy. No, wait, hold on a second. BlackRock dividend. What up, Jackie? How you doing? I see you in the chat on Instagram. KKR. Maybe my dividend calculation is broken because they should not all be pointing to dividends, but I'll check that later. Okay, let's keep going. Let's go into the calendar of events for the upcoming week. We have the macro plus Fed schedule. As a reminder, everything in black is stuff that we do feel is important and noteworthy for you, for all of us. We have core inflation data coming up on Wednesday. We've got the PPI month over month on Thursday, existing home sales on Thursday, and retail sales on Tuesday of the following week. And of course, the date and times are there. I don't think that any of this is going to really move the market. There is going to be a lot of continual conversation about employment and jobs. And I think that's just going to be in perpetuity as time goes by. I will pause here before we hit the sectors real quick to talk to you guys all face to face. That Super Bowl was wildly uneventful. I barely watched. Yo, Saeed Omar, back at it indeed. I missed you in the studio, brother. I didn't get a chance to talk to you this morning. I was on phone calls all morning long. Got a little bit of sniffles going on. It's allergies. But I'm going to call you. We're going to cuddle post-show, you and I. Deeply loving. Anyway, let's see what else we got on Instagram. Give us a reminder, Instagram does not feed into the chat. Jackie, I see you. Okay, we got a good healthy amount of people here. All right, good. Multiple different platforms. A lot of you on X today, which is an interesting twist, but all good. Let's jump into the sectors. Here we have the home builders. We're going to have some home building information come out later in the week, so I would keep an eye on this as we go. We watch the home builders as part of our rate-sensitive demand, so there is not a whole lot of volatility in rates that are impacting this in a positive way. As a matter of fact, I would argue that the current trajectory of the treasuries is probably leaning towards something that is not so good. Actually, no, the dividend ticker on the bottom is working, so not all those stocks have dividends. I think we're just in earnings season, and that's part of it. But let me check CNBC real quick, and we'll share and see exactly where the treasuries look like. And I want to show everybody how to do this because this is the routine that I go through when I check the markets every single day, so I don't have to watch CNBC. This is the CNBC. The irony of a Saks ad while they're in Chapter 11 and they're liquidating everything is not lost on me. We're going to go over here to the bond market, click bonds at the top. You get 10 years down. You got Japan is up. Okay, we're going to look at the U.S. 10-year, and we're going to watch this here. We're going to move this to 1 day versus 1 year. And you can see a pretty healthy decline here in bonds. So you're seeing some price pressures easing. Let's look over the course of the last 5 days. Close that real quick. And there's your 5-day chart. Okay, so again, we saw some pretty healthy drop-off and some pretty leveling here. So I'm not seeing anything that really gives me cause of concern for the home builds. If anything, the home builds are likely off based on potential sales numbers that are going to come up here not too long. Yes, Saeed, I promise. Let's get into some other sectors. The bank sector, which I'm a big fan of right now, is going to show us all positive green. This is the second day we've checked it and seen that. This goes to show you not only credit conditions, but I also think as net interest margins continues to widen for these banks, they continue to have more profitability. They're a great source of dividends in the future, as we saw down below here on the real-time ticker. I think banks are going to be underrated, particularly large banks. Community regional might be a different play. You want to invest in community regional banks, expect the M&A season for them to pick up visibly. Commercial real estate, there shouldn't be a whole lot of movement. You should see some ups and downs. There you go, ups and downs, but again, not big movement. Keep an eye on American Realty Tower. I think some of their exposure to office, last I checked, is a little bit high from my liking, but they seem to have some stability in this market. Nothing that really concerns me in that space. The mega caps, let's pull them up. There you go. Indifferent day. Microsoft and NVIDIA leading the way, but we don't track the entire Mag 7, largely because I didn't have space in the charts here to do that. But again, this is a tech-led rally, so you should be seeing these names lifting off a whole hell of a lot there. One of the things I'm going to do is pull down some AI additional information where whenever I pull up a stock ticker, no, I'll just use one example here. Let's use NVIDIA, okay? I'm going to go over here to my chart work and go to NVIDIA, NVDA. I'm going to hit generate chart, and I'm going to show you what that looks like as of today. This is NVIDIA Corp as of today. They're up 3%. What I'm going to add to this chart in the future is I'm going to actually bring this out here a little bit. So it's a more boxed in version because let's be honest, my face doesn't sell the show. And down here, I will have some AI driven one line statements as to why a stock may be increasing or decreasing on the day so that we can look at charts like this and have some perspective because we can't all be plugged in at all times. And you know what? What's the point of having AI if we can't have fun with it? Stay tuned towards the back half of the show where we talk about AI.com and that whole debacle that happened. NVIDIA's been having a pretty good run, as you probably all know, but let's take a look at the 3-month chart where we've seen some bumps in the road, largely due to the open AI conversation. And there you go, December, January, February. You saw a low here, you saw some dips here. That's some volatility. Now keep in mind the volatility is from 136 to 196, but $30 a share if you own a good amount of shares and you have the money to spend is some interesting trading activity. This is what we look at for volatility, by the way, on the synthetic volatility index. Is we look to see how much movement we have in a single day, which can become important. A great example of that is another stock. Let's take a look at that. Meta here, also part of the Mag 7. This is their 3-month chart, right? You're not seeing quite the volatility from December to February as you saw in something like OpenAI. When you go back to the single day chart here, you're probably be in the red, is my guess, slightly. Nope, green. I lied. Okay, there's your single day chart. Again, you're trading near session highs. It's showing a pretty continuous line up here from the opening gate to now. So this is not a chart you look at and go, okay, there's a lot of volatility. You're seeing consistent, steady trends throughout the day. But again, these are all perspective based and they can and likely do change throughout the day and the week depending on what data comes out. But part of the reason we don't track that sector in its entirety is we know it's a tech-led run. We have it down here. That's the market, okay? Don't forget that. Let's go into the next sector here, consumer. We know that consumer spending is coming out next week. I think that this is coming back off of what I saw, a little bit of influx. We saw the Dow really show a lot of movement into this space. So this backing off a tiny amount, Walmart slightly more than the rest, does not scare me a great deal. If anything, I think it's probably a healthy rebound back down. But let's look at Walmart, WMT. Let's see what we got here. Yep, it's down 2.6% today. 2.04%. So not a huge drop today, but let's look at it over the course of the last 5 days, noting that obviously on Friday you had a big bump in the day. Yeah, there you go. There's your Thursday, Friday. So it's just coming back down a little bit from this. So I don't see anything that strikes me as odd. You saw this big bump, in large part due to the Dow Industrial Average pickup. No, sorry. Yeah, it does that. Whenever I say the words and I'm underlining, it comes up. It's a little wonky. Yeah, it's not the sexiest look in the world, but we'll get there. All right, let's go back over to sectors, wrap up, then we'll touch on some AI, some forecasts, and then get into the fun part of the show where we talk all sorts of shit on all the things that are happening on social media, because that's what you're here for. Let's be honest. All right, let's go into the last couple sectors. I'll run through them quickly. The industrial should be up for today. Let's see what we look like here. Yeah, largely up. Caterpillar, Deere, General Electric. Energy, I had no idea. I'm going to guess positive. Yep, there you go. Positive for the day. Exxon, Chevron, Conoco, Schlumberger back down again. And the defensives, I'm going to say probably mixed day. There you go. Yeah, mixed day. So a lot of money that came in on Friday is sitting where it's at. Now, let's not forget Friday was a bit of an interesting day in the markets, and we saw one notable headline, which we owe it to ourselves to check on today. Let's go over to crypto on CNBC. Bitcoin is still down. You have not seen a rally back. It went down as low as, I want to say, 65, 63, was it? Let's see here. Oh, there it is right there. 63, 524. And it is back up to 70. But again, 70 is a really interesting benchmark and one that I really got to spend some time with Saeed and Rajil diving in onto the show. From my understanding, and this is from Michael Saylor and some other people that are far more intelligent than me, from my understanding, what's happening here is if it costs $70,000 or less, the cost to mine a single Bitcoin is more than the value of the Bitcoin at that price. Therein lying an underlying and fundamental problem. I think there are lots of people who are going to stay in this and continue to stay in the market because they believe that this is got a bright upside future. People talking about this going to millions of dollars versus just $100,000 because of limited supply of crypto in the markets. But certainly you're seeing a pretty big swing here that is still not changing. Now, if we see crypto start to spike up, I would expect to see the market drop in the same areas that went up. But again, that remains to be seen. And I don't know what the catalyst was for the drop, really, other than this risk-off commentary that we saw on Friday. I don't know what would put risk back on at this point based on the ambiguity around how it all came off in the first place. Let's go over to XAI. This is our trending now analysis for those of you who are new to the show. This is going to run out to the stock markets and run out to the social media world and take a look at some of the trending topics. If any stocks in particular are mentioned whenever we do a forecast, it'll show as trending on the forecast model. This is our hedge fund light kind of look at the markets so that we can make informed decisions based on some of the things we're seeing from a rhetoric perspective. You cannot deny that Reddit and X and even Instagram to some degree do have impacts on the market. So this is our way of respecting that and bringing it into our analysis whenever we're looking at how the market is. You're not going to get this on CNBC, and you sure as hell aren't going to get it anywhere else. This is proprietary to us. So we scraped Instagram and X, and stock market rallying to new high. Major U.S. indices are extending gains with the NASDAQ 100 up 1% and S&P 500 approaching record highs, just like the Dow did on Friday. Major markets showing strong bullish momentum after recent correction. Wild. AI's inside here, rally coinciding with AI spending concerns, suggesting institutional rotation rather than retail euphoria, potentially more sustainable. And what it's really getting down to is if money is leaving cryptocurrency risk off and pulling back a little bit from the Mag 7 and some of the mega caps into the small caps, and you see small caps rally, that could be a safer, more long-term viable investment place, right? A place to put your money. There is some contested positions on this, so the controversy score is something to look at here. If you had wild consensus, it would be on this side of things. If you had a generally divided consensus, it would be this way. And this is very much contested. There's varying degrees of thought on this. And I should point out, in a very important and intimate moment, that anybody watching this show needs to understand that fitness, religion, politics, and investing, money, and frankly, health and nutrition in general, these things are like gospel to people, and you've got to be very careful about how you offend people's traditional notions. So it doesn't surprise me that people who are very heavy into crypto are contesting the sentiment that money going into mega caps is good and vice versa in a social rhetoric narrative capacity. People on X will argue, and again, I shouldn't have to tell you, but I'm going to, the dead internet theory is real, and approximately 61% of the internet activity is based on bots, AI, and other non-human factors. We've heard differing opinions on X being 20%, according to Elon Musk, bot accounts, and some people as high as, call it 80% in some circumstances, depending on the analysis. We don't know, but we do know there is a large proponent of bot accounts. So take the social narrative with a little bit of pause in that we don't know as far as what's driving it. We just know that the intent is to clearly drive this type of extremism and divide, even when it comes to something as simple as where you should put your money and invest in stocks, because there's always some kind of underlying theory. Rant over, I promise, but it's an important point to make here. Let's go back to the XAI for a little bit. OpenAI, ChatGPT growth surge. ChatGPT showing over 10% monthly growth, with OpenAI preparing to launch updated chat model this week, signaling continued AI momentum. And I've seen some of their updated modeling stuff. It's pretty good. Claude also launched their modeling. It changes a little bit here and there. But I think stronger user growth, like AI is suggesting here, does validate the AI investment thesis. And we're seeing some particular niche models roll out. I'll use Claude as a great example because I spent some time this weekend looking into that. Claude has a legal specific model. They have an Excel document model. These two things are going to be aimed squarely at two particular fields: legal analyst work and financial analyst work. And if they work well, then guess what? They're going to be exceedingly disruptive to first-year law employed people, whether that you're a paralegal or you're a first-year attorney. It's going to be extremely disruptive to analyst work. When I started in banking and finance, I spent a great deal of time working in Excel sheets, and that landscape is going to change dramatically. I don't know that you need to know some of the Excel coding that we once needed to know. And somebody out there is going to be like, look, man, I never use my mouse whenever I'm on Excel, and I'm so cool. Good for you. Great. Developers did the same thing, and we went from having individualized developers to full stack developers to now just AI will develop based on vibe coding, which is really just me in plain English communicating to AI, saying what I want and getting the results back. Not 100% perfect and far from it by every stretch of the imagination, but certainly you're already seeing this happening. Used car price inflation returns. We're going to spend a little bit of time with this on social media. This, to me, is a very troubling factor, particularly given the fact that so many vehicles are underwater on day one. That's in large part due to the drive off, but also when you lose money, you drive off, but also because the interest rate environment and because people are taking cars that are financed and putting that on the new car they buy, so they're getting additional financing to get over 100% out the gate. Wholesale used vehicle prices surged 2.4% month over month in January to the highest level since September 2023, well above historical averages. Used car inflation returning suggests persistent service sector pricing pressures. Fed may need to maintain hawkish stance longer than markets expect. And frankly, if you've been listening to David Kelly and JP Morgan, you know that their new updated model, and they are an outlier here statistically, is that they are not, calling for any rate cuts this year. And the first rate activity would be in 2027. It would be a rate increase. This would align. I got to figure that out, because whenever I look at the screen, this is my right, that's my left. It's awkward. They're talking about how this could impact things. So this affecting consumer discretionary spending is also something that you see in the models. And of course, I don't need to tell you that. We can go right over here to the sector model, and I can go down to the particular sector we were just talking about here, consumer. And guess what? You see that showing up in consumer sentiment. So again, you see how a lot of the social narrative and things you're picking up from social media can give you some insight as to what you're likely going to see in the stock market and why. Prices of these things increase the way they have seems to show a more hawkish tone from the Fed is likely. You're going to see consumer sentiment pull back. Consumer sentiment means less consumer discretionary spending, which is in fact why we call this a consumer health chart. If you bear with me and you watch the show enough, as obnoxious as I am, it will help you understand the markets better, I promise. And I got a couple more XAI things to cover, but I also noticed there's a lot of activity in at least one of the chats here. Let's see what we got here. This is on X. Saeed in the comments display, if someone looked past the headlines and focused only on where the capital is actually flowing right now, bonds, equities, real estate, private credit, cash, what else? What would those flows tell us about where the economy is headed in the next 12 to 18 months? Okay, well, the short answer here is that it appears to be an influx into a couple different sectors and a couple different business types. You're seeing a build-up into what I think are smart decisions, frankly. The energy sector. Okay, you're seeing money go into energy. You're seeing money go into industrials, hence the reason why the Dow hit what it did. You're seeing money go into the banks, right? And frankly, there are some other places you could argue that money is going into, but I think small cap, right? You're not large companies, you're smaller companies is going to see a boon in large part in response to this. People think the mega caps, AI, the CapEx, this uncertainty is really starting to make people feel uncomfortable. So they're going to go into the smaller businesses where there's been good growth and there still is upward size potential. And when you think about this logistically from just a behavioral human economics perspective, here's the way this works. Big companies, the mega caps, right? They're going to invest a whole ton of capital expenditure into new technology and lead the way. The small caps, the smaller companies don't have the same level of discretionary ability to spend on massive capital expenditures. So they tend to go into less revolutionary technology. They tend to go into more stable, tried, true, and tested stuff, unless their business happens to be one that's disruptive. So for example, Robinhood was very disruptive. They tried a very disruptive path forward, but that was their entire business model, so they did take a different tact. But I guarantee you the stuff they implemented internally as far as systems and infrastructure go was tried, true, and tested technology, because they can't afford to be on the bleeding edge of technology from a systems and infrastructure spectrum, whereas some of the mega caps can and will do that to get ahead of the curve, because they have to compete and they have to be nimble, right? And a great example of this is, let's say Meta goes out and they decide they want to deploy new technology, but TikTok's way ahead of them. That's a problem. AI is this new sphere. For a while, it was virtual reality, then it became augmented reality. Now it's, there's a whole back and forth, but certainly AI is something that these larger companies are competing for market share because they think it's going to be their business, while smaller caps will continue to have upside potential and less market risk, it seems like, and not only the redeploying of the assets back into CapEx, but certainly in the long-term growth potential. So banks, energy, industrials, small cap, that's where I see the money going near term, unless something signals the risk on perspective. And based on everything that we're seeing, even the most general consensus of the world interest rate probability and Bloomberg's, actually, let's just go down this path, shall we? Let's go down into Chicago Mercantile Exchange. Let's see where Fed rates at. Fed now. Okay, so we'll go to the Fed Watch tool over the CME group, and you can all pull this up. This is free access stuff. You don't have to have any special Cool Kids accounts to get it. And let's go to the widescreen. There you go. This is target probability for the March 18th, March 2026 Fed meeting. 350 to 375 versus a Fed rate cut. So you got an 82.3% probability to stay in the current range. And if you can see this, which you probably can in the vertical format, it says the current range is 350 to 375. Staying at the current range at 350 to 375 has an 82.3% probability. Getting a 25 basis point rate cut right there is at a 17.7% probability. So again, the general consensus is that you're not going to see any rate cutting environment, which means we're not going to see an overriding risk profile change outside of something happening in the corporate world. So I think this risk on, risk off perspective for cryptocurrency is here to stay for at least a period of time longer. How long? Well, that remains to be seen. Let's go into a couple more pieces from the social sphere here. HMS stock collapse. This is HIMS stock collapse. Yeah. So there's a lawsuit that's been filed around this. I saw this morning. HIMS and HERS health stock experiencing significant decline with social media accounts that promoted it, notably absent from the discussion. HIMS collab exposes risks in social media driven healthcare stocks, regulatory crackdown on telehealth, likely accelerating sector wide repricing. And the long story short of this, let me actually, let's HIMS stock. I think HIMS is literally HIMS. It is. Yeah, look at that. Someone was creative there. Let's get into that a little bit, and let's talk a little bit about what that stock chart looks like, because I think that's going to be a great place for us to start some social narrative. This is from HIMS. This is a single day chart. I'm going to pull up the stock chart here. There we go. HIMS and HERS Health. Okay, so not so bad despite the rhetoric. They started off a little low, so they rebound a little bit, but you're going to continue to see pressure on these companies. And the reason why is that a lot of them, so I guess probably back this up a little bit. I'm not a technical expert here. I'm just going to try to be as colloquial as possible. So forgive me if somebody's smarter than me on this topic. The way this works is that let's say you wanted to buy a GLP-1, right? That's interesting. This is showing HIMS is down. Did I look at the wrong chart? Hold on. 1876. This is showing, that's weird. I'm showing a 4.25, 1840, wait, hold on. 1877 is what I'm seeing. Yeah, that's right. But this is showing, down today, 18.46% versus, so this is versus the one. Okay. Let's take a look at this 5-day chart here. Let's compare something. Let's take a look at that actually. Okay, so here is, yeah, I don't like that chart either. What the hell is going on here? Let's take a look at that. Here's your HIMS and HERS Health for 1 month. Here's your 5-day chart. Yeah, this is not a good trend. And when you compare that to the screen one here, which I like ours better aesthetically for all sorts of reasons here, it looks a little off. What was causing me concern was the 1-day intraday here, 1880 versus our 1-day chart here. And the reason why this happens, and this is actually probably worthwhile to share for those of you who watch the charting world, we like to compare intraday, where it's at on the day versus where it's at versus the previous close. I think that's where a lot of things change. So this opened at 1783. So it's currently up relative to 1783, its open price. And that's why you saw kind of this starting up here the day here and spiking back up a little bit there to where it's at. Whereas if you look at it to yesterday's close, which I want to take a look here, it's going to be notably lower than that. Previous close was 2302. So this is down from 2302 from the previous close where we look at this intraday. So there's a big difference that you guys need to be aware of whenever you're looking at stock prices and markets. There's a big difference between showing where it's at versus today versus where it's at when it closed last time, which in this case was Friday. So I don't think there's a whole lot of response here. But to get back on topic, a lot of people will sell a GLP-1 like tirzepatide. And what they'll do is they'll add something to it so it's not their proprietary blend that makes it tirzepatide, typically B12 or something like that, a B vitamin. And then it'll sometimes look pink in the bottle or something like that. And they'll sell that as a compounded product. And there's lots of people who object to compounding pharmacies for reasons we don't need to get on the show. But suffice it to say, there's workarounds like this that allow people to sell products that typically would come from places like Eli Lilly, for example. I think you're going to see some lawsuits in Novo Nordisk or Nordzik. I can't say the name. In Supermicro and some of those companies that do this. But I think you're going to see some challenges with the way this is happening during the next couple of quarters because GLP-1s are so revolutionary. And then you have retatrutide, which is coming up in the back end. It's in their phase 3 trials, the FDA. So I think that a lot of these companies that popped up in these niche luxury genre, Hims is definitely one of them, are going to face a lot of challenges in at least legally in the next couple of years. I want to see cheaper products for everybody. That's kind of my end goal here. I don't really invest one way or the other. I do like the compounded products for all the obvious reasons, including the fact that I use them. So keep an eye on that space and some of the litigation that comes through. We really need to rethink how we do this as a society, but that's another conversation for another day. Now, I do want to cover the forecast model. This is the dead chart. I did that on purpose. I want to show you what this looks like whenever I pull it up. So I'm going to go over to the forecast model. I'm going to hit HIMS because we know that's a conversation point here. I'm going to generate the chart, and this is what it looks like when it actually happens in real time. So I want you guys to see that because the static chart that was there before is what we see whenever we're not doing anything. I hit that in, I press enter, and this is what happens in the back end. You see that fluctuation, but I don't see this in advance. I see it at the same time as you guys do in real time. This tells me that it is a trending topic on social media. We also know that because we just covered the social media chart. We know that the price is up intraday, but down versus the previous close because we just covered it. It's saying to caution the trade here. It's allowed, but be very cautionary around it. If you're going to buy something, don't buy options, buy shares. And the time horizon here is a short trade. The volatility is not something that makes people feel confident in the long-term durability. Plus, we know there's some litigation risk here. Is the risk level low, medium, or high? It is certainly elevated. So when you look down here, the primary drivers are, we have a very calm market from a synthetic volatility index, which we covered at the very beginning of the show. But we're seeing liquidity drain from the system, and core inflation month over month seems to suggest that consumer discretionary spending, which, believe it or not, will likely take an impact. So expect this to have longer-term pain, rather short-term warm and fuzzies. Just a reminder, if it's in this space, it usually suggests to watch the stock, not to trade the stock. Typically in this space, 60 to 80, set up for a trade, and by the time you're here, it's a strong trade opportunity. I don't really see a whole lot of green, to be honest with you. I may have to recalibrate this chart considering how negative it can be. Let's look at something like NVIDIA. We talked about that to start the show a couple minutes ago. I think that's also a good one to take a look at. NVIDIA Corp, same scenario here. Lots of positive momentum in the stock price. The market has the same indicators we talked about here before. This one's looking closer towards setting up a trade, but certainly advising caution shares, intraday trade, and an elevated risk profile. You're going to see an elevated risk profile until you really get more liquidity in the system. And the model functions this way to try to calibrate for a risk-off perspective due to liquidity not being flush in the markets for people to buy. Once you see liquidity swing back the other way, you're going to see a lot more trade recommendations. Right now, the models are frankly just scared of what likely could and may be after this whole cryptocurrency debasement debacle. I'll go over to the comments on the Instagram. What up, Instagram? What up, Bardad? How you doing, brother? Same last name, so sexy. Rosie, just in time for the chart work. Yes, you are, Rosie. Hi, Rosie. Hi. There you go. I'll head on over to X and LinkedIn. There we go. Okay, let's spend some time on the social medias. I promised we would talk a little bit about the car market. We're going to do that right now. All right, let's get over to the social perspective. There it is. Market breadth is surging. 65.6% of the S&P 500 stocks have outperformed the index over the last 3 months, the highest reading since late 2024. This is the fifth strongest market participation in 23 years. By comparison, the long-term average is about 50% with 20-year low. So the market is, in fact, surging. Meanwhile, mortgage rates, here you go, Lance Lambert, up to 6.16, same day last year, 7.03. So we haven't seen a whole lot of volatility in that. That was very close where we were on Friday. We covered that on Friday's show. This is an interesting statement because we saw where Bitcoin was at earlier. And you got to take this with a grain of salt, right? There are pundits who will try to put media and news like this out there to try to drive the price up. It is technically market manipulation, but the cryptocurrency, particularly Bitcoin, is the wild, wild west in that regard. This just in, billionaire Peter Thiel and Palmer Luckey's $4 billion Bitcoin startup, Erebor, just became an OCC chartered bank. This is huge. Actually, that happened last week, and it is not I think they call this a Bitcoin startup. It is a bank whose focus will be in part cryptocurrency, but they have a lot of disruption and things they want to do. So I don't know that I'm necessarily in love with that headline, and I don't really think it's been that impactful, but don't take my word for it. We'll jump right back on over to CNBC. I'll put you on the wide screen here, and we'll go right over to crypto and see where it's at, shall we, kids? Oh, look at that. It did not spike because of that news. So again, the sensationalized headline, nonsensical stuff, sometimes it's just headlines. You got to see through them. You got to parse, as we like to call it. We parse through. Amy Nixon, startling but consistent with the aging population. Older retired people in paid off homes make up an increasing percentage of our population. Yeah, 40% of the population owns their home in cash. It's probably close to retirement age for most Americans. Yeah. So again, nothing super surprising there. No energy drinks today. Sad. Massive. President Trump says we are preparing to do something big with crypto. Markets don't ignore statements like this. Pay attention. See, and again, from the Crypto Squire. You know what? I'm gonna do it. I'm gonna do it. Let's see if this is much ado about nothing, or there's any value in this, or what it really could be, right? And I shudder to do this because every time I see this, it's usually somebody who's saying something that doesn't really strike me as real. But you know what? Let's see.
Your embracing of crypto, very different from the previous administration. Strategic Petroleum Reserve like for crypto?
Yeah, I think so. We're going to do something great with crypto because we don't want China or anybody else, and not just China, but others are embracing it, and we want to be the head. We're going to be ahead of AI. We're going to be way ahead of AI, and we've got to produce tremendous amounts of electricity. You know that it's unbelievable when you think that we need more than twice what we already have. If you think that's pretty for a specific industry, but we'll be able to do it. We have Lee Zeldin in charge of the environment. He's going to be giving us very strong approvals, I think, and he's going to make sure everything's good and clean and proper, but he's going to give us very fast approvals.
Natural gas.
Yeah, I don't know that I heard anything from that made me go, oh, okay, there's going to be something changing there. So, again, headline, and then you're like, is this AI driven? But no, I don't see anything there that strikes me as impressive. This conversation is interesting. So I'm gonna spend a little time here. Warning to Airbnb jocks. A decade ago, private credit firms started offering small investors short-term loans to flip houses. It's true. I'll go to the social narrative here. To build rentals. They finance up to 90% of a project at 8% interest, betting on the home's projected value after completion. That is true. Private lenders have started foreclosing on 7.4% of the properties they financed in Cape Coral, Florida in 2023. That's nearly 4 times the rate of typical mortgages. Last year, initial foreclosure filings on these loans quadrupled from 2 years earlier. Nationally, oh, look at this long article. Look at that. Nationally, they spiked 82% during this period. Home prices in Cape Coral dropped 11% year over year, the biggest decline in any large metro. And it really comes down to this chart here. Flipping gets harder. U.S. Federal Housing Finance Agency purchased only home price index year over year change. Yeah, I think that's right. So I think Airbnb, which was fodder for a lot of conversations for you guys all need to get in on this trend. It's an opportunity. All these core sellers were doing it. There's all these Airbnb gurus. I went to war with a lot of them. For those of you who followed me on social media, they really pimped this hard. There's also the Section 8 proponents who pimped that stuff hard. And the idea of flipping became very sexy and sensationalized. And I think a lot of flippers were just, making a ton of money. And that time has come and gone. Also a recessionary signal if you want historical trending, not necessarily suggesting a housing recession, but certainly an economic recession where people aren't spending as much money as they had historically. And as you see with the consumer pullback in spending, it's probably the case. But I see this over and over again. You got to understand that if you want to get into a rental property business, you need to stay in it and plan for longer duration hold. Airbnbs are nice in that you can get more money for your property rental versus a monthly rental. But then you're taking what should be a passive ownership business and a third-party property manager, and you're making it an active business because you're now a service-based business, i.e., hospitality. Hospitality is commercial real estate. Under the regulatory definition, so is multifamily apartment complexes or renting property out like that. But I would argue that the housing component makes it a much more sticky client if it's done the right way, and it makes your money more stable. You need to look no further than how hotels function during recessionary economies and hospitality functions, particularly non-flagged, unbranded hotels historically, to think how Airbnb could play out for a lot of people. So I think that sensationalism has died down. I think there's also a social narrative. People don't like those transient occupancy tenants coming into their area, particularly if they have families and small children. So I think that whole thing is going to slow down a whole lot, and you're either going to get really, really good at the service aspect and actively running your business, or you're just not going to be in that space. And it certainly wasn't this, boon windfall of opportunity that was painted on social media years ago. And you've seen that change. A lot of these course sellers are now in the Cody Sanchez camp. I don't like her, truth be told. Of buy all these businesses. And that is also not, they all want to pitch it like they're hedge funds or like they're venture capital and like they're Alex Hermosi. Okay, well, if you employ people to manage those businesses for you and you can trust them to manage the business for you, good for you. That ain't most Americans, and that's a much more active business. And if you're going to be on social media doing all these things, i.e. selling courses, it's more likely than not you're selling courses on how to do these things and making the bulk of your money versus actually doing them and making the bulk of your money. If you want my honest opinion, I think the algorithms should be public. I think people who make statements about selling courses online or selling opportunities should be much more public about how they make their money. And frankly, the overwhelming majority of people on social media who talk about these things don't have a visible pedigree that you can actually look at and say that makes sense of how they got there, right? There's very, very few people in the social narrative. You look at even Alex Hermosi, and people talk about him, and he's been very transparent, but 99% of what you know about him came from what he has told you about him. Right? No knock on him, just an example. Now, he's done some things that has been in the public eye that you now can tell, but Cody Sanchez is a great example, right? All these things she said she's done, and she said she worked at all these companies. Great. Well, I worked in finance for a long time too, and I can tell you that the tenure that she spent at some of these companies didn't give her a lot of real working experience and could not have in that time frame. So take it all with a grain of salt. Airbnb, frankly, as far as I'm concerned, is dying, if not near dead, as it relates to a sensational new business. What the hell is this? Chamath, we bought a bank. I don't even want to click on this, but I'm going to do it anyway. Beast Industries, the entertainment conglomerate founded by Jimmy Mr. Beast Donaldson, has agreed to buy Step Mobile, a teen-focused banking app. The company's plan to announce banking app is not a bank. Teen-focused banking app. The company's plan to announce Monday the acquisition will expand the YouTube star's reach beyond media, restaurants, and packaged food into financial services. Founded in 2018, Step Mobile runs an app that offers a federally insured bank account without fees. Again, does not make it a bank. It just makes it a banking app, and you can partner with banks. A lot of fintechs do this where they use the bank's charter. Banks will sell this as banking as a service to them, and then if you look at the fine print, it's actually a different bank. Helps individuals establish credit before they turn 18. And they offer a secured visa that helps individuals. Most secured credit cards don't report into the agencies, so I would like to see how that works before I take that claim on it. Investors led by General Catalyst, valued at $920 million in 2021, but its valuation, like those of many fintechs that raised money at the time, is likely to have dropped since then. The company's declined to comment on the terms of the transaction. Beast Industries was last valued at $5.2 billion and currently has around 500 employees. Donaldson's, who is reality style, blah, 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 blah. Well, good for him. I mean, you know what? Good. I do think that's a hard demographic to capture. I don't know. I do financial shows like this all the time, and I can tell you that the teen demographic is much more into sensationalism. So how are you going to encapsulate their interest in that and get conversion should be an interesting case study. But, this from John Brooks pretty much sums it up. Houses are overpriced. You think? Yeah. Home value income ratio, 1970 to 2025. And we've talked about this a great deal. So I'm not going to spend a whole lot of time on it. This is from Zillow, Case Shiller, and the U.S. Census Bureau. Yeah. There are only 3 ways housing prices get more affordable for most Americans, but we have charts for that. Interest rates can come down. I don't see that happening anytime soon. Average mortgage rate is 6.16% as of today. They need to be somewhere below 5%. That's another percent down, and you could probably afford about 20 to 30% more home, depending on how you qualify. But you need to have housing prices come down and wages go up. If you didn't change anything, wages have to go up about 58% for average Americans to do that. And those who are watching going, well, that's inflationary. Yeah, it is. So I get it. There is no clear and concise answer on how to do that. So there you go. All right. Well, let's call it a wrap today. It's Monday. We had a very boring Super Bowl. Oh, I do want to tell a story about AI. I want to do that first. So you guys all saw the AI.com commercial. If you haven't seen it, it's got an interesting back and forth. Sam Altman owned it. Elon Musk owned it. It was eventually put up for sale again for $100 million. Sold for $70 million. The AI startup is supposed to do something. Keyword something. And nobody really knows what that something is. And it had a Super Bowl ad. They ran a Super Bowl ad, and I went to the page when I saw a Super Bowl ad saying, reserve your username now. Go through the process, and what it did is it then asked you to reserve your username. You put it in, and then ask for a credit card. Says that you'll be charged in the future, but you don't know what you're reserving a username for. AI.com, reserving a username, asking for my credit card. Like, what am I paying for? Like, what's the service you're providing? And then on top of that, the actual website crashed. It is the most expensive domain sale in history at $70 million, paid for with a guy from crypto space who paid in cryptocurrency, as you might imagine. And it didn't work during the Super Bowl. I actually had to do this later on just to kind of figure out what it was. So it goes to show you that if you're going to run very expensive ads and pay $70 million for something, it may be worthwhile to, other than build off of the stigma of what it could be because it sounds sexy with a great username and you're collecting people's credit cards, to tell them what they're actually signing up for. You know? That's all I'm saying. Let's go to the comments and we'll call the show a wrap a little early today. What up, everyone? How you doing out there? Let's see who we got here in the comments. You know, it always trips me out because there's a bit of a delay on live streaming, and on this particular stream we got X, LinkedIn, and YouTube streaming at a different cadence than the Instagram stream does. The Instagram stream is a little bit behind, so for those of you who join and you're like, oh, yo, this is a little weird, you know, whatever. It's awkward for all of us. We do have an exciting show dropping tomorrow. It'll be episode 321 of the Higher Standard Podcast. You guys check it out. Said and I spent a lot of time making that one extra sexy, where Jill is back in the studio for that one. And, I would like to say that we did some good work, but we all know that we do amazing work here only. So there you go. Unless anybody has any comments. Yo, my sister's in the chat. How you doing, Sam? I see you out there, too, on the Instagram side. For everybody else on YouTube, X, and LinkedIn, I apologize. I've been a little laggy on the comments today. That is what I normally do in a day to get started for the day and prep on where the market's going. I guarantee you could watch CNBC for 4 hours. You get the same amount of information, the same amount of just kind of overall emotional connection of what's going on by doing this. Until next time, everybody, we love you. Okay, bye.